What if inflation wasn't an accident? What if it was a strategy? A quiet lever pulled behind closed doors. A tool that builds empires, pays for wars, and shifts power without a vote. Who would benefit? Who would lose? And when did the game begin? Everyone knows inflation erodes purchasing power. Fewer know that it can erase debt even faster. And in a world drowning in IOUs, erasing debt is priceless. But here's the mystery. How did inflation become the heartbeat of global power? And why do the same few players keep winning when prices rise? Let's rewind. Money began as a promise. Gold coins promised metal, paper promised gold. Then the promise changed, and power followed. Centuries ago, rulers clipped coins, stretched silver, and diluted truth. Debasement funded wars without raising taxes. People felt poorer. Kings grew stronger. The template was set. A modern version arrived in 1694 with the Bank of England. It financed war debt. It normalized state borrowing. And it taught a lesson that echoed across the world. If you control money, you control outcomes. America followed a familiar path. Civil War, greenbacks broke the gold link. Debt was paid in softer dollars. Pain later, survival now. The principle worked. By 1913, after crises and panics, the Federal Reserve was born. It promised stability. It delivered something else, too, a flexible money system just in time for World War I. Prices jumped. Debts shrank in real terms. And a pattern formed. Big shocks, big printing, big consequences. The 1920s chased normality. The 1930s rejected it. The Great Depression brought deflation, bank runs, despair. Franklin Roosevelt didn't wait. He seized gold from citizens. He devalued the dollar against gold in 1934. Same coin, new promise, less gold per dollar. More power to steer the economy. World War II pushed the lesson further. Governments capped interest rates. They let inflation run above those caps. Economists call it financial repression. Citizens earned negative real returns. Debts melted quietly. The war got paid. The bill was hidden. In 1944, Bretton Woods reorganized the global system. The dollar would be convertible into gold for foreign governments at $35 an ounce. Other currencies would peg to the dollar. Keynes argued the blueprint. Washington held the keys. The arrangement bought time and credibility. But it also planted a fuse. By the 1960s, America pursued guns and butter. Vietnam abroad. Social programs at home. Deficits swelled. Foreign central banks asked for gold instead of paper. The London gold pool tried to keep the price steady. Speculators attacked. Confidence cracked. In 1971, Richard Nixon ended dollar-to-gold convertibility. He also froze wages and prices for a time. The promise of money changed again. It was no longer about metal. It was about decree. Fiat was born fully and finally. A government promise backed by its central bank and its taxing power. The 1970s responded with pain, OPEC shocks, stagflation. Inflation exceeded growth. Arthur Burns hesitated. The system wobbled. Then Paul Volcker stepped in. He pushed interest rates near 20%. He induced a deep recession to crush inflation expectations. It worked, but the cost was global. Emerging markets buckled under dollar debts. Defaults spread. The IMF arrived with conditions and reforms. A new pattern emerged. Borrow in good times. Tighten when the tide turns. Sovereignty traded for stability. The 1990s delivered a calm. They called it the Great Moderation. Low inflation, stable growth. Markets soared. But there was a catch. The safety net of central banks got bigger. The Greenspan put arrived. Each crash met with easier money. The dot-com bust, then housing, then everything. In 2008, the global system broke. Mortgage securities imploded. Banks froze. Lehman failed. Central banks went all in. They created reserves in unprecedented scale. Quantitative easing became normal. Zero interest rates became policy. Balance sheets swelled from under $1 trillion to over $4 trillion at the Fed. Europe followed. Japan doubled down. Consumer inflation stayed muted. Asset inflation did not. Homes, stocks, and bonds rose. Those closest to the flow of new money gained first. So the Cantillon effect at work. Wealth concentrated. Growth limped. Discontent brewed. For a decade, central banks chased a 2% inflation target. They begged for a little more price growth. They even tried negative rates in Europe and Japan. But you can't print demographics or productivity. The cure wasn't curing. It was just feeding assets. Then 2020 arrived. A pandemic froze commerce. Governments did the unthinkable. They flooded households and firms with cash. Central banks bought the debt to keep rates near zero. The line between fiscal and monetary blurred. In the United States, M2 money supply surged by roughly 26% in 1 year. The fastest peacetime jump in modern history. The bill came due in 2021 and 2022. Inflation ripped higher. 9.1% CPI in the US at the peak. Double digits in parts of Europe and the UK. The word transitory aged poorly. Rates jumped at record speed. from near zero to the highest since 2007 in the US. Mortgages spiked, bonds cratered, banks holding long bonds took losses. Silicon Valley Bank collapsed in 2023. A new emergency facility appeared overnight to backstop deposits. Once again, the money engine saved the system, but it did not undo the hidden tax. Look at the numbers. The Fed's balance sheet swelled to around $9 trillion at its peak. Japan's central bank owns more than half of its government bond market. In 2022, the Bank of England briefly intervened to stop a pension fund spiral. Real rates turned negative for millions of savers across economies, and global debt surpassed $300 trillion. When you owe that much, inflation isn't chaos, it's policy. Because inflation changes politics. It shrinks the real value of fixed promises. It shifts wealth from savers to borrowers. It helps governments manage debt without explicit cuts. It rewards those with assets that reprice. It punishes those paid in cash wages that lag. We've been here before. After World War II, the US capped yields and let inflation run. Debt to GDP fell sharply by the 1950s due to growth and negative real rates. Today's tools are slicker, but the logic is the same. Keep nominal rates below inflation for long enough. Let time do the heavy lifting. Call it stability. Call it prudence. But it is a choice. The fallout is visible. Housing affordability near multi-decade lows in many countries. Food and energy spikes hit the poor the hardest. Household budgets compress. Meanwhile, equity indices recover quickly after each rescue. Corporate borrowers refinance with ease. Governments roll trillions at manageable yields. The system survives. Citizens adapt. And when fixes fail, the pattern repeats. Wage and price controls in the 1970s. They backfired. Quantitative easing as a temporary crisis tool. It became permanent plumbing. Yield curve control in Japan as a bridge. It became a trap. Transitory, rebranded as persistent but declining. The vocabulary changes. The incentives do not. If this is weaponization, how does it work? Simple mechanisms. Create more base money to backstop crises. Suppress yields through purchases or guidance. Let inflation run ahead of rates when debt loads threaten. Reassure with forward guidance to keep expectations anchored. Move slowly enough that outrage dissipates. Move quickly enough that spreadsheets balance. Repeat. Is it a conspiracy? No. It is a set of incentives baked into institutions. Democracies avoid explicit pain. Central banks avoid systemic collapse. Politicians prefer growing into promises rather than cutting them. Inflation becomes the invisible referee, but patterns carry warnings. Trust erodes when prices feel rigged. Polarization deepens when assets soar and wages lag. Currencies wobble when policy cred fades. Japan wrestles with a weak yen after years of suppression. Europe battles energy price shocks layered on loose money. Emerging markets face dollar-strength whiplash after U.S. hikes. The world tilts with every pivot. 3 takeaways stand out. First, inflation is not just an accident of shocks. It is a policy tool that solves political math by stealth. Understand that, and the headlines make sense. Second, money creation redistributes before it stimulates. Those closest to the spigot benefit early. Those paid in delayed cash lose. Protect yourself by owning assets that adjust, not promises that don't. Third, the cycle is structural. Debt levels force choices. Central banks can tighten to defend credibility, or they can soften to defend solvency. They rarely can do both for long. So where does it go next? Watch 3 dials. Debt servicing costs as a share of revenue. Real wage growth versus inflation. And the slope of the yield curve under stress. If servicing costs explode, repression returns. If wages lag, pressure mounts. If curves invert and break, rescues follow. Here's the uncomfortable truth. Inflation will be used again to ease the burden of promises that can't be kept in real terms, to stabilize balance sheets when politics cannot, to rule the global economy without saying so out loud. You don't have to accept it blindly. You can question the narrative, you can study the incentives, you can prepare, hold a diversified mix, understand your timeline, hedge the hidden tax where you can. If this challenged your assumptions, stay with us. We go deep on the mechanics behind the headlines. Subscribe, share this with a friend, and add your take in the comments. What part of this system do you think breaks first? And what would you do if the temporary tools never end?